Today, we're diving into the financial backbone of every business, the balance sheet and income statement accounts. If you've ever wondered how companies track their money, you're in the right place. The balance sheet shows what a company owns, assets, what a company owes, liabilities, and the owner's stake, equity. Meanwhile, the income statement tells the story of a company's revenue, expenses, and profits over time. But what do all these numbers really mean? And how do different types of accounts fit into these financial reports? Stick around and we'll break it down simply and clearly. Understanding business finances, the key accounts in balance sheets and income statements. By Easy Peasy Accounting. But before we dive into that, let's go over the basic theory of debits and credits accounts. In our previous video, we explained the concepts of account, T-account, debits, and credits. Let's take a moment to revisit debit and credit accounts. The dealer rule helps you understand how different accounts behave. Which accounts are debits and which credits? Dividends, expenses, and assets in their natural state have a debit balance and increase with debits and decrease with credit. Dividends. That's when the company distributes its profit and cash to the owners. Expenses. That's money we pay for goods or services the business purchased. Assets. That's the resources the company owns and uses, like buildings, machines, equipment, and so on. Liabilities, equity, and revenues in their natural state have a credit balance and increase with credits and decrease with debit. Liabilities, which is money we still owe to others, like to the bank, to suppliers, or to the IRS. Equity, that's the money the owners of the company put into the business. Revenue, that's the money we receive for sales to our customers. What are the main balance sheet accounts? Assets, liabilities, and owner equity. The balance sheet equation is assets equal liabilities plus owner equity. Assets are in the left side of balance sheet. Liabilities and owner equity are in the right side of balance sheet. Assets in their natural state have a debit balance and increase with debits and decrease with credit. Assets. That's the resources the company owns and uses, like buildings, machines, equipment, and so on. Here's a brief explanation of each assets account. Cash and bank represents the company's available cash held in bank accounts. Accounts receivable, amounts owed to the company by customers for goods or services sold on credit. Allowance for doubtful accounts, a contra account to accounts receivable, estimating uncollectible amounts. What is a contra account? A contra account is an account that is used to reduce the value of a related account. It typically has a balance opposite to the normal balance of its associated account. For example, allowance for doubtful accounts, its natural state is credit. It is a contra asset account that offsets accounts receivable. It estimates the amount of receivables that may not be collected. Accumulated amortization, its natural state is credit. Depreciation and amortization, reduction in asset value over time due to use or aging. It reduces the value of office furniture, office equipment, machineries, building, etc. by tracking its depreciation over time. Contra accounts provide a clearer financial picture by showing adjustments directly on the balance sheet instead of hiding reductions within the main accounts. Tax refundable or paid on purchases, they are taxes paid on purchases that are expected to be refunded. Purchase prepayments, payments made in advance for future purchases. Office supplies, costs related to supplies used in daily office operations. Computer supplies, expenses for computer-related consumables like keyboards, mice, and cables. Inventory, in a merchandise company, inventory refers to the goods and products the business holds for sale. Inventory tablets, stock of tablets available for sale. Inventory cell phones, stock of mobile phones held for sale. Inventory laptops, inventory of laptops available for sale. Inventory, accessories, includes various computer or phone accessories in stock available for sale. Office furniture, furniture used in business operations. Accumulated amortization office furniture. A contra account to office furniture account the total depreciation recorded for office furniture. Equipment, business machinery, and tools used in operations. Accumulated amortization equipment. A contra account to office equipment account depreciation recorded against business equipment. Liabilities and equity in their natural state have a credit balance and increase with credit and decrease with debit. Liabilities, amounts owed by the company to creditors or suppliers. Here's a brief explanation of each liabilities account. Accounts payable, amounts the company owes to suppliers or creditors for purchases made on credit. Bank loan, a loan borrowed from a bank recorded as a liability until repaid. Tax payable or tax charged on sales, they are the sales tax collected from customers that must be remitted to the government. Prepaid sales, payments received from customers in advance for goods or services to be delivered later. Equity, that's the money the owners of the company put into the business. Here's a brief explanation of each equity accounts. Jacqueline Hubert, capital, the initial investment Jacqueline Hubert has made in the business. Jacqueline Hubert, contributions, additional funds or assets provided by Jacqueline to support business operations. Jacqueline Hubert, withdrawals, a contra account to Jacqueline Hubert, capital account. Its natural state is debit amounts taken by Jacqueline from the business for personal use, reducing equity. Income statement accounts are purchases, expenses, and revenues accounts. Income statement equation is revenue minus expenses equals net income, profit, or net loss. Expenses, that's money we pay for goods or services the business purchased. Here's a concise explanation for each expense account listed in income statement. Purchases tablets, cost incurred from buying tablets for resale. Purchases cell phones, expenses related to purchasing cell phones for resale. Purchases laptops, costs associated with acquiring laptops for resale. Purchases accessories, expenses for buying accessories such as chargers and cases for resale. Purchase returns and allowances, it is a credit account contra account that tracks returns and adjustments on purchased items. Purchase discounts, it is a credit account records discounts received on purchases, reducing total expenses. Advertising expense, costs related to promoting and marketing the business. Rent expense, money spent on leasing office space or facilities. Telephone expense, expenses incurred on telephone services used in business operations. Office expense, general office-related costs, including supplies and maintenance. Electricity expense, charges for electricity usage on business premises. Bad debt expense, amounts related to uncollectible accounts receivable. Interest and bank charges, financial costs such as loan interest and banking fees. Revenue, that's the money we receive for sales to our customers. Here's a brief explanation of each revenue account. Sales tablets, revenue earned from selling tablets. Sales cell phones, income generated from cell phone sales. Sales laptops, earnings from laptop sales. Sales accessories, revenue from selling accessories like chargers, cases, or peripherals. Repair service revenue, income earned from repair services provided to customers. Sales returns and allowances, It is a debit account, a contra revenue account tracking refunds and adjustments for returned or defective products. Sales discounts. It is a debit account contra revenue account reflecting discounts given to customers on sales transactions. Changes in revenue and expenses directly affect the owner's equity balance. The business's aim to earn revenue that exceeds costs, ensuring sustainability and growth. Revenue and expenses directly impact on the owner's equity, which represents the owner's claim on the business's assets. Here's how. Revenue increases owner's equity. When a business earns revenue, it boosts net income, which ultimately increases owner's equity. Higher revenue means greater profitability, which strengthens the owner's financial stake in the company. Owner's equity is classified as a credit account. Since revenue contributes to increasing owner's equity, revenue is also recorded as a credit account. Therefore, both owner's equity and revenue are considered credit accounts. Expenses decrease owner's equity. Expenses reduce net income, leading to a decrease in owner's equity. If a business has more expenses than revenue, it may operate at a loss, which erodes the owner's equity over time. Expenses lower revenue, and less revenue means a smaller increase in owner's equity. Since expenses go against revenue, they are recorded as debit accounts, which also makes them the opposite of owner's equity in accounting. The equation that ties them together is owner's equity equal beginning equity plus net income minus withdrawals. Since net income equal revenue minus expenses, changes in revenue and expenses directly affect the owner's equity balance. How it appears in financial statements. Income statement shows revenue minus expenses to calculate net income. Statement of owner's equity starts with beginning equity, adds net income, and deducts owner withdrawals, leading to ending equity. Balance sheet. Ending the owner's equity coming from statement of owner's equity is reported alongside assets and liabilities. And that's how we learned about the key accounts in balance sheets and income statements. If you enjoyed this video, don't forget to hit that like button. It really helps the channel grow. Share this with your friends who might love this too. And if you haven't already, subscribe and turn on notifications so you never miss out on exciting new content. Your support means the world to me, and I can't wait to keep bringing you more.